Hello, this is the third weekly episode on the Oil and Gas Investor channel. In today's episode, we discuss the most important developments in the oil and natural gas markets. Extreme cold in the United States likely triggered a record decline in natural gas inventories this week. U.S. oil and gas production may decline due to a major winter storm. Adjusted earnings per share of ExxonMobil and Chevron have been falling for the third consecutive year and may decline further in 2026. And finally, how to profit from a potential decline in natural gas prices in February. The first position has been opened in the oil and gas investment portfolio. Now let's move to the top news of the week. A winter storm in the United States led to a sharp decline in oil and gas production. Dry gas production is estimated to have dropped toward 92 billion cubic feet per day last weekend, before recovering during the week to above 104 billion cubic feet per day. As for crude oil, as much as 2 million barrels per day of lower 48 production was offline over the weekend, including 1.5 million barrels per day in the Permian Basin. As of Thursday, total offline production had declined to around 500,000 barrels per day. For comparison, in January 2024, U.S. oil production fell by around 1 million barrels per day due to Winter Storm Heather. Cold weather has the strongest impact on natural gas prices. On Wednesday, U.S. gas prices surged to their highest levels since 2022. The decline in prices on Thursday was driven by the expiration of the February futures contract. We warned about this decline in the previous episode. As a result, natural gas prices fell 17.5% over the week. Oil prices rose 6.8% week over week. On Thursday, prices reached their highest levels since September last year. The main driver of higher oil prices was the increased probability of a U.S. strike on Iran. Investors are most concerned about potential retaliation by Iran, including attacks on oil production facilities in the Persian Gulf and a possible blockade of the Strait of Hormuz. Around 20 million barrels per day of oil and petroleum products are exported through the Strait of Hormuz each day. The Donald Trump administration eased sanctions on Venezuela's oil sector, including crude exports, by issuing General License 46. This includes operations directly related to the export, sale, transportation, storage, and processing of Venezuelan oil. Sanctions on oil production itself remain in place. The easing of sanctions coincided with the approval of a major reform of Venezuela's hydrocarbons law, which removed PDVSA's monopoly powers and opened the sector to private investors. On Friday, the largest U.S. oil and gas companies, ExxonMobil and Chevron, reported earnings. We will discuss them in more detail shortly. Now let's move to the oil market. Data released last week highlighted several trends in the U.S. oil industry. Declining oil prices are beginning to negatively affect production volumes. After reaching a record level of 13.85 million barrels per day in early December 2025, U.S. oil production has been declining almost continuously for 7 weeks. Data for the current week will also show another decline, although this will largely be weather-related. Demand for petroleum products in the United States remains weak. Inventories of petroleum products are at their highest levels since 2020. Gasoline inventories, which are primarily used by private drivers, have also reached their highest levels since 2020. This is happening despite a significant increase in net exports of petroleum products since 2022 following Russia's invasion to Ukraine. Meanwhile, U.S. strategic petroleum reserves have increased by 15%, or 68 million barrels, from their 2023 lows. Another important trend is rising production efficiency. Strong growth in U.S. oil and gas production in 2024 and 2025 occurred despite a decline in the number of active drilling rigs. Now let us introduce the crude oil traffic light, which we will use to assess oil price dynamics. In the short term, developments around Iran will be the key driver for oil prices. If the United States manages to change the regime without a significant impact on the oil and gas sector, oil prices could fall sharply. However, if the Strait of Hormuz is blocked, WTI prices could reach $100 per barrel. A weaker U.S. dollar is providing support to commodity markets. In 2025, the U.S. dollar index declined 9.4%, and it has fallen another 1.4% since the start of 2026. Oil prices also continue to face pressure from excess supply. In 2025, OPEC Plus production quotas were increased by 2.9 million barrels per day. In reality, production has risen by around 2.3 million barrels per day since early 2025. In addition to OPEC+, oil production has increased in the United States, Guyana, Brazil, and other countries. This has led to a surplus in the global oil market. Easing sanctions on Venezuela's oil sector also adds downside pressure to oil prices. From a technical perspective, oil prices appear slightly overbought, with the RSI approaching overbought territory. Now let's move to the natural gas market. For the week ending January 23, U.S. gas inventories declined by 242 billion cubic feet, compared with a 5-year average decline of 208 billion cubic feet. Forecasts suggest that over the next 3 weeks, inventories will decline significantly faster than the 5-year average. Rapid inventory declines will support gas prices. However, we do not expect a strong rally from current levels, as the March contract remains the key benchmark. As of January 23, U.S. gas inventories were 5.3% above the 5-year average. By February 13, inventories could be 11.3% below the 5-year average. As of January 30, gas storage facilities in Europe were 42% full, compared with a 5-year average of 58%. Gas prices remain relatively high, and cold weather continues to support demand. However, this week we cannot provide a clear forecast for gas price movements next week. The most aggressive investors may consider the ETF KOLD, which rises when natural gas prices fall. Now let's move to the oil and gas investment portfolio. On Friday, ExxonMobil and Chevron reported results for the fourth quarter of 2025. The share prices of both companies appear completely disconnected from fundamentals. ExxonMobil's adjusted earnings per share have declined for the third consecutive year, and in 2025 were 51% below 2022 levels. In 2026, earnings per share could decline by another 1% year-over-year. Do you think the stock has fallen by 50% since early 2023? It has not. ExxonMobil shares have risen by 33%. Similar behavior can be observed across many oil and gas stocks, which is why we are not rushing to buy at current prices and are preparing to short U.S. oil companies. Is the situation different at Chevron? Chevron's adjusted earnings per share have fallen by 61% since 2022 and could decline by another 9% in 2026. Despite this, Chevron shares are up around 2% since early 2023. Next week, ConocoPhillips, Phillips 66, and the European oil and gas major Shell will report fourth quarter 2025 results. ConocoPhillips' adjusted earnings per share could decline by 46% year-over-year, while the stock is up 13% since the start of the year. This shows the extent of the bubble in the U.S. stock market. Lower oil prices are positive for refiners. For Phillips 66, adjusted EBITDA could increase by 118% year-over-year. Adjusted earnings per share could reach $2.15, compared with a loss of 15 cents in the fourth quarter last year. Phillips 66 shares are not attractive at current levels, as all positive news is already priced in. Shell shares are trading close to fair value, and are also not attractive for new purchases. In 2026, Shell's adjusted earnings per share could decline by around 2%. Now let's move to our investment portfolio. We decided to speculate on a potential decline in natural gas prices in February. We purchased the ProShares Ultra-Short Bloomberg Natural Gas ETF, ticker KOLD, allocating 10% of the portfolio. This is a very aggressive and high-risk position. If you decide to buy KOLD, we recommend allocating no more than 5% of your portfolio. Next week, we will be looking for entry points into short positions in U.S. oil companies. The main risk to this strategy is a potential U.S. strike on Iran. For this reason, we may wait for such an event before building short positions in the portfolio. If you found this analysis useful, don't forget to like the video and subscribe to the channel. We publish weekly insights on oil, natural gas, and energy stocks, with a clear focus on fundamentals, geopolitics, and market positioning. See you next week.